What is the inflation story?
I think it's a good story. It's a Goldilocks situation. Now, I haven't been able, obviously, to look at the details. There may be some things that are moving up at a faster pace. Obviously, gasoline prices probably went higher, and that's why the core, the ex-food and energy, is so important at 2.1%. Another piece of data which came out this morning is also real earnings, and so they're at 1.2% year over year. So again, for the households of America, for the average consumer, they're earning wage increases that are above inflation, and that's important.
Well, so I'm just wondering, Mark, Constance is saying this is Goldilocks, this is good. So how long can this Goldilocks period be withstood before something breaks down?
Well, as Chair Powell said, there are transitory factors. We had apparel, we've had asset management, we've had transportation, a number of things that have gone down and other things have gone up. I think it can continue for a while, and I agree with Constance. I think it's constructive. The big risk, as we see it, to markets away from near-term noise around trade is a move up in inflationary pressures that would cause the Fed to pivot, like we saw in the fourth quarter of last year when the markets had to deal with a potential of withdrawal of accommodation. That, to me, would be a big risk to the leveraged finance market, to the equity market, and with inflation numbers like this, that just doesn't seem imminent.
So, Constance, I have to come back to the trade dispute, because if, in fact, we do impose this 25%, which we have now on, it's a total of $250 billion, and then he's talking about another 25% on the remainder part, at what point do producers have to start passing along to consumers, and would it show up in a CPI?
Yes, it will begin to show up in CPI. It's not, by our calculation, not going to be hugely significant, so several tenths of a percent. The Fed would likely look through that. And let's remember, though, that and they'll look through it because after a year it will pass, right? You'll get the year-over-year effects. They'll feed through. The subsequent year it will pass. And again, because it's not demand-driven, right? So it's unlikely to be sustainable. The other thing is that when we have an increase of prices on tariffed goods, domestic producers or even imported non-tariff goods then realize that they can increase their prices in line with the increase on tariff prices.
Washing machines, for example.
Right.
Remember,
yes,
the prices
exactly.
went up not just for the ones imported from the countries.
Exactly. So it pushes up inflation across the board, which ultimately slows growth because it's not demand-driven, it's shock-driven.
So as we speak, we are seeing markets currently price in a greater chance of a rate cut by January of 2020. You can see that in general, markets have steadily been lowering their expectations for a Fed funds rate, increasingly expecting that there could be a rate cut. Even without a downturn, this whole idea of an insurance cut kind of picking up. Mark, do you expect the Federal Reserve to make a move lower before year end? And do you think that the market's gotten ahead of itself?
We think the market has gotten ahead of itself, and we do not see a cut this year or next year for that matter. Because we do believe that for a variety of reasons we'll ultimately get to a trade deal and we will ultimately resume some of the growth trends, not just in the U.S. but globally, such as Asia, that will then filter into Europe a little bit. So we're going to be in this Goldilocks type scenario. So we don't see rate hikes. What that market may be telling you is that if we get a slowdown, the Fed will move aggressively, and as opposed to that a cut is imminent this year.
So Mark has said more than once he believes ultimately there will be a trade deal, but certainly the likelihood of that is smaller today than it was a week ago. Would you agree with that?
No, I think it was always small. I think that the fundamental differences.
Disagree with Mark?
I do a little bit. I think the fundamental differences between U.S. and China have now shifted. It used to be that we would have conversations with China. We and our allies around the world would have conversations with China where we could make an argument, this is in your interest to make moves in these directions. And they said, yes, we agree. Now, they are not saying, yes, we agree. They are saying, well, there's a benefit to having state-owned enterprises. We need to have local champions. So it's a different conversation that is a deep fundamental difference.
If then we are going to see these tariffs for the longer term, does that affect the inflation picture? Because people will be spending more on goods and there will have to be higher costs for certain things. So even though there are fundamental differences, there may be a veneer of a deal that smooths this over, because this is tariffs are a deadweight loss. They hurt the American consumer. The American consumer pays for them. There is every reason to make a deal, but don't be fooled that if a deal is made, the fundamental structural differences have been resolved.
What is the ultimate potential upside if a deal does get done?
ultimate potential upside. Well, I think
Let me put it more bluntly. Will the game have been worth the candle?
Well,
we've gone through a lot of turmoil for 2 years now, and the market's been up and down and all around, and a lot of money has been made and lost. But in the end, if we get a deal with China where we say, you know what, 10 years from now, boy, that was worth it.
Yeah, well, as Constance says, they're very deep structural issues, and they're all different levels of quote-unquote deal. There's a big deal, a deal light, a kind of cosmetic deal. They're all different levels, so it really depends. But look, we're in a period of deglobalization, and this is going to have, there are going to be several fits and starts as Brexit happens, as the China adjustment happens, as new trade deals come into play. And so they're going to be fits and starts. So I think it's a long series of events that are going to play out over time.
So just real quick here, I'm curious, do you think the next move in equity markets is materially higher or materially lower? Constance?
I think if I were to forecast over the next 6 months, I think I would vote in favor of slightly lower rather than slightly higher.
What about you?
Yeah, I wouldn't say it's material, Lisa, I'm sorry, but I think it's going to be, we're going to trade in a range.